come out the door like, yo, excuse me, who you looking for? And the guy come out, I'm looking for you. Boom, 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 boom. And shot me like 5 times. It was crazy.
What?
Yeah, shot me 5 times.
It's like no big deal.
That was the best thing that happened to me, man, because adversity brings growth, right? There's things in life that you go through that really make you look deep within.
3, 2, 1.
Today we have Fuquan Bilal.
Correct. Bilal.
Nice. Bilal. Fuquan is probably got one of the craziest work life experiences I've ever heard when it comes to real estate investing. I had the pleasure of spending like 2 hours waiting at the airport, waiting to get back to Newark after one of our mastermind conferences.
That wasn't pleasure. The sitting there waiting for the flight. That was delayed.
It wasn't a pleasure for him because I was asking a lot of the questions and he was just kind of mentoring me. But Fuquan just started telling me some of the just insane stories. So, guys, if you're going to listen to an episode, this one's incredibly inspirational. You're going to get a lot out of it. Fuquan, thank you so much for coming on the Deals and Dollar podcast. How you doing today?
I'm doing great, man. It's an honor to be here. This is my hometown. I was excited when we were in the airport. You was like, hey, I got this podcast. Why don't you come check it out? And I was like, sure. He was like, hey, it's at my office. And I'm used to doing podcasts and Zoom. So this is actually the second podcast that I've done in person. The other one was Steve Train, where I had to fly out to.
How was that?
It was great because I staggered it around the mastermind where we actually, set it up and did that. But actually, I didn't get a chance to do that because we set it all up. We were excited about it. And the day I was supposed to do it, I had to fly home for emergency because my 14-year-old just started high school and he was not waking up while I was at CG. The school kept calling me and I'm sitting at the mastermind. They're like, your son is not in school. I'm like, oh my God.
Oh,
because he, summertime, eighth grade, teenager kid staying up late overnight. And then he went to high school. I flew out. And he wasn't getting up. I mean, the school was a block away from my house. So it's like, dude, you can't get up. It's crazy. So I had to fly out and go back, and I missed the podcast.
All right, so rock and roll. This is the first of hopefully many deal. Yeah, Deals and Dollars, baby. Fuquan, I don't think I'm going to be able to do a better job explaining who you are and what you do. Can you just kind of tell the audience a little bit about yourself?
Sure. I mean, I always like to start off with, and we was chatting about it before we press record, that I'm a superhero to my kids. That's really important to me because when I got into the business, like most people, what we are is a slave of the money instead of a master of it. And what I mean is we're always chasing the next victory, the next thing, right? So when you get to the top of the mountain, you got to keep going up and up, right? It's never over. And for me, I wasn't the best father to my kids. So until the market crashed, as I was telling you, the story was in the airport when the market crashed in 2008. I had started real estate in 99, jumped out the window, grew wings, falling down, as I always say. Had the opportunity to ride that wave and made a lot of money. Young kid, started off at 24, made a lot of money. Of course, all the materialistic stuff, the cars and the trips and all the other stuff that we do. I didn't have financial literacy growing up, so to me, the fancy car and the Gucci and Louis, that was, that was the worth, that was the value,
right.
Until you have everything and then you're like, okay, this is it. But when the market crashed, I learned a very valuable lesson because I lost $2 million of my personal money, had a lot of money tied into the deals. I paid all my investors back, had to start all over again. And I said that was the best thing that happened to me because it really showed me truly who my friends were and basically what was the real value in life. And I quickly understood that family was important. So my phone stopped ringing, deals stopped happening. Things were bad financially, wound up going through a divorce, liquidating a lot of assets that I had. And, I basically got custody of my boys, and that was the best thing that ever happened to me because, first of all, I didn't want another man to pass their values on to my kids. So me having the opportunity to sit in stillness, right, with my kids because business completely slowed down. I had other businesses that was an offspring of what I did with real estate. So I started to wind those businesses down and really focus on my kids, right? Taking them to school, picking them up, taking them to the park, playing. I think at the time the game was Foursquare, with my boy. It was the second, third grade, whatever. And I had a little smaller kid. So raising those two boys really made me become the man who I am today. So I always like to start off with saying a superhero to my kids. We actually just came back from Sarasota this weekend, going through like Triumph, which is like a really crazy parkour type course to go through. But I do a lot of stuff with them. They keep me active, they keep me young, but that's kind of really what really helped me make the transition in my life to becoming the man who I am today. So, yeah.
Amazing.
I mean, that's how I got into the note business. My son, actually, he was there at the time, and when the market crashed in 2008, around 2010, after I reconciled everything, got back on my feet, and I stumbled upon the note business from doing short sales, because that was the thing that was prevalent at the time, short sales. So my son heard me talking in the car, talking to a negotiator, wouldn't do the deal, and I was like, oh, I mean, these banks don't want to give a homeowner a reprieve. And he was like, why don't you just become the bank? And I was like, that's impossible. He's like, Dad, I thought anything was possible. And I was giving him all the motivational talk, and I'm like, So I was like, yeah. So I started to look into it, and I learned about how to create a fund. And I started to call a lot of SEC attorneys. I was calling all the shops that's like the all-in-one. We'll do the PPM for you. We'll help you raise capital, and we'll take 90%, and you do all the work. We give you 10%, right? And they just give you a boiler template, and you really don't understand how a fund operate. So I started calling around, interviewing SEC attorneys, and a friend of mine actually referred me one that he was using, consulted with him a few times, and he really educated me on the whole process of how a fund works. And for me, I looked at it like, that's the bank right there, setting it up. And that was a great experience, going through that whole process. But yeah, that's how I got into the note business.
So I think it'd be useful if you could just tell everybody kind of where you're at now, and we could work it backwards into how you got there.
Yeah, right now we manage a $50 million fund. This is our 5th fund. We cycled through 4 funds successfully. That's a whole different business. So for those of you who want to go out there and raise capital, don't think it's like, oh, I can flip deals, I can run a fund, I can do it. It's really take a lot of focus, and it take time, it take track record, right? Because imagine you're taking somebody's savings. Mm-hmm. They have to know, like, and trust you in that order, right? Mm-hmm. So we're in a podcast now. People are getting to know us. Eventually, they'll watch some of our content. They'll like us, and eventually, we bring value. Then they'll trust us, and they'll do a deal. That's the pyramid. So, basically, that's a whole other business. It take time. It take time to build a track record. What are your historical returns? Investors look for stuff like that, and it take years to get to that level. Even if you've been in real estate for 10 years, but you never ran a fund, you're day one in that business. So people don't realize that, right? Yeah. You have the real estate track record, but you don't have the capital management track record, which is completely different, right? So, for us, that we had to go through the ups and downs and learning that business, and it's like having kids. I always relate running a fund is like having kids, right? You learn as you go. You have pain points, great points. So, that's where we are now. And pretty much our business model consists of fix and flips and multifamily. We do have some notes in the fund, some legacy stuff. Our model has changed over the years because the market changed. So you have to be able to pivot with the market, right? So, what I try to do is use the tools in my tool belt from things that I've learned over the years. And at the end of the day, it all comes down to real estate, right? So we buy a note, and the homeowner don't pay, we foreclose, it becomes an REO. It's a fix and flip deal, right? It goes back to that. Or if it's out of state, now we can actually find a local investor and do a seller carryback. Now it becomes a note. That's another strategy, right? Or we can buy a tax lien, foreclose on it, make it a fix and flip, or a rental, whatever it is. It's all real estate related at the end of the day. So over my 24-year journey, just utilizing the tools that's in my tool belt to kind of get to the exit point, the best way I can.
Beautiful. One thing that really sticks out to me, Fuquan, is what you did when shit hit the fan. When you lost $2 million and you said all your investors got their money back. Yeah.
I mean, for me, you could, and the funny thing is, my accountant at the time was like, hey, dude, just file bankruptcy. You don't have to pay this money back. And that was the advice I was getting from my accountant. File bankruptcy, you walk away, you start all over. And for me, it was like, okay, if I put myself on the other side, now if I was an investor and they was losing money like crazy, I was hearing the stories, people were just walking away from stuff. That was what was happening. People were strategically defaulting on their loans, to try to get a loan out and rework it out. People was gaming the system. And for me, it was like, okay, I took these people money, I made them a promise. And if I can make it to the other side, you know, these relationships would still be there, right? People don't understand. There's a whole nother part of raising capital is that relational capital that people don't look at. They just look at the money, but have a relationship. Just you guys have relational capital invested. There's equity in your relationship. And when people look at it like that, there's more value in just, you know, filing bankruptcy and starting all over again, right? So, yeah, for me, it was I'll pay them back because I had to fire sell everything. That's how come I took the short, because things were 55 cents on the dollar.
So what were you doing? This is '08, right? And what were you were flipping houses?
That's all I was doing. Okay. No rentals.
Got it.
No rentals.
So you had a bunch of properties. Market took a dip. You have all these investors, and now you're underwater on.
Correct. And I had to fire sell, and some of them were done with construction, some of them were in the middle of construction. So the way the deals were structured was investors would give me capital, I would put up 20% of my money, and then a rehab. So I had skin in the game.
Okay.
Right. So they had low leverage. I had skin in the game. Hey, I could put up 20% and I can do all the rehab. Right. Rehabs back then was $80,000. We had a lot of projects going. I had stuff in Philly, a whole portfolio in South Philly before people started going to Philly. I was in Philly in 01, 02. And when we would get properties for like $6-7 grand,
it's crazy.
It was crazy, yeah. In South Philly, like where Home Depot was at, South Street, all that whole area. I was down there. It was like you could own a whole block for like 50 grand. It's crazy, right? I mean, but you had to deal with what was down there too. It was the streets, the hood and everything else. But so it was exciting exiting out of some of that stuff in like 05, 06. And I would say I pretty much exited out of Philly before the market crashed. And what happened was, because I was in Philly, I didn't have the capacity to do Philly and Jersey. So I was just doing deals, right? No structure, no operation, no EOS in place, none of that stuff. Just like, willy-nilly. And I learned my lesson. My ass got handed to me, and I got punched in the face. But I fight better with blood in my mouth. I like adversity. I grew up through adversity, growing up in Newark and growing up through hardship. That's what make you stronger, right? Going through that adversity.
And so, you took it on the chin and you paid back every single investor.
Paid back every single investor. And in fact, I still have some of those investors that invested with me today.
Wow.
Yeah, absolutely. Yeah.
That's amazing.
Yeah. So to me, I looked at it as a lesson, right? So most of my money was tied up into the property. Plus, I had to still keep paying interest for some of this stuff. So at the end of the day, when I looked at it, it was like, I don't know, 1.93 or something like that. So, yeah.
Wow.
Yeah, so $2 million, like, wow. And it took me really almost 2 years to get out of everything, to liquidate, sell. Because I didn't want to take a cheap, like, 55 cents on the dollar. Like, no, it's worth more. But everything's around is, like, cheap. So a good friend of mine said, look, just sell it all and come back in. But still, it was really tough. Short sales was really prevalent then, up until probably maybe 2012. I mean, it's still happening now, but I mean, really, where it was like short sale operations. You walk in and an attorney has 300 files under process, right? So, those are crazy times. But I'm grateful for those times, because the people who was just getting started in real estate or before COVID, right? And then when COVID happened, they're like, holy, what's going on? This is crazy. Those are the people who I saw really struggle and close shop and go out of business really quick. And even now, there's people who struggling, who came through that and was like, oh, that was the worst thing happened. You thought they would have learned their lesson, stress tested the model a little bit more. Like, we're still buying at the model we built when it was COVID, when we thought the world was about to end.
Right.
And we were like, okay, we need more holding costs. We need to stress test this with, higher interest rate, longer holding costs, stuff like that. And it's hard to find deals when you do that, right? To put it in that buy box. So, yeah.
Fuquan, I think one thing that you mentioned, and what would be crazy if I didn't ask, is you've been an operator. You started off in the hood.
Yeah, for sure.
You're born and raised Brick City, represent, right?
Brick City.
Let's go, baby.
Newark, baby. Come on. And you acquired assets throughout, some of the toughest parts of New Jersey and in some of the most dangerous areas of Philadelphia. While you were in these areas of Philadelphia, what were some of the most memorable and impactful stories that you encountered?
Wow. I'll tell you one quick funny one. When I first got started, I really didn't understand how the contracting business worked. And we had a contractor who finished the job. We went to go do an inspection, and we was turning on the water. We flushed the water, and hot water came out the toilet. We flushed the toilet, and hot water came out the toilet. Like this, it's steaming. Like,
What?
what? I mean, they had literally crackheads doing the work. Yeah, so it was crazy. I was like, why is it hot water in the toilet? It's supposed to be it's not like a. That's a funny story. So I mean, for me, what gave me my feeling of importance, David, was really going back into the communities, adding value, putting the properties on a tax roll, giving the residents a better place to live. Because I grew up, you know, in the 80s, right? When crack hit the street, you walk outside your house, you see dope, crack vials, needles, like syringes and stuff. It was just crazy. So growing up in the area, seeing a lot of, it was just desolate, seeing a lot of dilapidated properties, burnouts, fire. It wasn't really as bad as you see the visuals from the Bronx back in the 80s. Like, it was crazy, right? But stuff like that. So when I had the opportunity to come in and buy in those areas, because that's all I knew was where I grew up at, right? So if I can buy a house over here, fix it up, right? So you become like the hood hero. You begin to hire people within your community, people who have records and stuff like that, right? Guys who get arrested, I can't get a job because I got a record. We have this demo job for you. This is all we can have you do. We can set up a demo crew and have you demo all these houses and clean up and just do small work and that. So we did that. And the most memorable thing I would say was, I remember March 30th, 2001, I'm sitting in my office. At the time, I had a partner, which was a cousin of mine, and he actually got me into the business. And I used to shadow him around when I was working in corporate and did a deal and just, you know, put my 2-week notice in. But a year and a half later, we were, you know, already in the mix, and I was in my office March 30th, 2001, and it was this setup, basically. It was a robbery. We was paying everybody cash. And basically, I guess someone got wind of it, and we had already made payroll earlier that day because it was my cousin's birthday, so we made payroll. I'm in the office, the door open. We're in Irvington at the time, and so somebody walked past my door, and I'm like, "Who is this?" Come out the door, like, "Yo, excuse me, who you looking for?" And the guy come out, "I'm looking for you." Boom, 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 and shot me like 5 times. It was crazy.
What?
Yeah, he shot me 5 times, and I got stitches like coming all the way up here.
If you're not watching, he has
staples,
like a gash all the way up
stomach,
his stomach.
stapled, and bullet holes here, and everything else. So
crap.
I had actually played dead for the guy to leave because
He goes,
you know,
I was shot 5 times. It was crazy.
yeah, it was crazy, and that was
It's
the
like,
best
no big
thing.
deal. It's 50
That
cent,
was the
bro.
best thing that happened to me, man. Because the first thing was that happened to me.
Best thing.
No, seriously, right? So what happens is, as I mentioned, adversity brings growth, right? So there's things in life that you go through that really make you look deep within, right? The second thing for me was when the market crashed and I lost the money. The third thing was my divorce. The first thing was when I got shot 5 times. Because when that happened, again, your circle, who you're around, right? You got to pay attention to that. You can't think because you're going into a community helping people that people are grateful, that they're going to protect you. No, it's I wasn't really paying attention to my surroundings and the people I had around me, right? So that really woke me up and go deeper within to myself. So I kind of cut everybody off, family members, everybody. I kind of cut everybody off and went deeper into myself. And I was more successful that year than I was previously, right? That year I actually sold 34 houses. That happened in March. It took me really about 6 months to heal, but I was working from home, working out, trying to get back on my feet. And I learned how to appreciate the small things that you probably forgot about you did this morning, tying your shoe. I couldn't even bend down to tie my shoe.
Wow.
Putting my pants on, taking a crap. You know what I mean? People these are simple things that you do every day that you take for granted. That really helped me learn to appreciate the very small things in life, right? That was really impactful. That's the most memorable thing that I can think of. And I'm grateful for that because it actually made me stronger, right? It made me more resilient.
Was it people in your community? Did you know who did this to you?
Well, the guy who actually shot me, he actually is, he's probably gone for life now because he had shot a truck driver in Pennsylvania. I think the story, what I read in the paper, he rode down Pennsylvania and stole a motorcycle. He ran into a toll booth. The state trooper chased him. He dipped off, got away, found the truck driver, took the truck driver by gunpoint hostage, made him drive him all the way back to Newark, shot him in the head and left him dead on the side of Valley Fair, Chancellor Avenue, Valley Fair over there.
Yeah.
Shot him in the head, left him dead there. He was with another kid, snitched on him and told on him. And yeah, so he got like, they was trying to give him the death penalty because it's common law in Pennsylvania, whatever that is. And I guess he copped out to life. So for me, it's like, again, I'm grateful that that happened because of the circle that I was in, the people that I was in. It still was like a street element.
Yeah.
So for me to separate myself
You
from
gotta
that,
move it.
and then, you know, started going deeper into myself, reading books and learning more about life and stuff like that. You know, it was great.
So, like, obviously you grew up in this environment, right? And you're saying, you know, there's a street element of your circle. What is it saying? Like, you're the average of the 5 closest people to you. So, and now look at you, right? You know, successful by all measures, not just money. It seems like you have a great family and great people around you. How did you manage to break out of that?
Yeah, for me, well, let me go back to success. As Larry Yacht says, success is an optimized daily experience sustainable over time. It's not how much money you have, how much accolades you have, degrees and all that. It's an optimized daily experience sustainable over time. For me, I'm grateful that I grew up in this community because when you have street smart, most of the time you will outwork a lot of people, right?
Mm-hmm.
You can see the snakes coming. You can see certain people trying to get slick. So that's helped me a lot in the corporate or the environment that I'm in now. And then I walk through a lot of rooms and I look at people like, wow, they have no idea where I come from and, you know, the way I grew up. And just to be grateful to be in these rooms, that kind of, you know, make me feel good. But going back to your second part of your question your question actually was, how did that make me feel going through that where I am now? You mentioned it, right? So if you want to grow, you got to get around people who's smarter than you. And that's one of the reasons that I joined Collective Genius, right? So I knew I would be in a room where there's people 100 times smarter than me, not by just a bigger business or bigger things or doing more deals, but just doing things different, right? That I can learn from. So I look forward to going to those masterminds every time to learn more, to make myself become better. Right, your business will only grow to the extent that you do. So starting to read and hang around other people will help me grow to another level, and I constantly, you know, want to do that. As Les Brown has a saying, OQP, only quality people. You know, keep those people in your circle, and you always grow. Right. So yeah.
Amen.
I love that.
Amen. You know, Fuquan, you have when I first met you, I was like, what is it that you do? Right. And you told me something really powerful, the mission of your company and why it is that you do what you do on the multifamily side, right? How did your, you know, experiences working in these neighborhoods, trying to give back but still getting screwed, how did those experiences shape the way that you approach real estate investing today and influence the strategies that you use to really succeed in these markets?
Yeah, that's a great question. I mean, there's good people in these areas. In low-income areas, there's good people. I grew up in that, so I know there's good people there, right? And you really got to look at it as, like I mentioned earlier, when I first got into real estate, it was about the money, right? And then when you get to a certain level, you're like, okay, you know, what value are you bringing? So now it's about the impact.
Yeah.
So being able to go to these communities where I know I can add value with my skill set, that gives me my feeling of importance. So that's really our mission today, is to go into tertiary, secondary markets like we're in Macon instead of Atlanta, right? Everybody wants to go to Georgia. Oh, I'm investing in Atlanta. I'm doing multifamily in Atlanta, right? So we're in Macon, which is a secondary market. We know that it's up and coming. We can add value there. We're in Columbus, which is another tertiary market where we know military base. We know we can add value there as well. And it's just such good feeling when you can go into the property, renovate it, bring it up to standards, and give the residents a better place to live, plus providing the low-income people still a place to live. Because most of the people that go into multifamily, they play as, oh, I'm going to buy it, they run some CapEx, raise rents to the max, and we're all going to make great profit. But there's not a lot of people who say, I'm going to keep a certain percentage of this building, unless they're forced, you know, from the government to do that, right? Most of these new buildings you see going up in like Livingston, Short Hills and stuff, they got to keep 25% for low income to mix it to get them into the school system. So we kind of follow that same model to make sure a percentage of our units are government backed, battered women and children, Section 8. If it's a program, like we have a River Edge program in Macon where it's like disability people, maybe AIDS patients, people, stuff like that. So, we provide housing for all of the above. So,
I love that, man.
for sure.
I love
For
that
sure.
to be able to combine your business acumen, make money, and also make an impact. I think that's really admirable, man. Really.
Yeah. That's really what saved us through COVID, really, those government-backed programs, because they kept paying,
Right.
So,
God has a funny way to come back, right? That's awesome. Fuquan, you and Steve have a very similar.
Lloyd.
Steve Yacht. Steve Yacht. We call him. He used to be Steve Lloyd, but after he hit big, he bought the yacht, and now he's Steve Yacht, right?
My best life, yeah.
So you and Steve have an unbelievable fund structure.
Well, Steve actually is not in my fund. He has his own fund.
Right.
Actually, Steve mentored me on how to raise money. Yeah, he mentored me. So Carl Fisher, Camera Plan, IRA company. He actually came to speak at my first note event, because when I got into notes and I started to educate people about notes, right? So when I first started buying notes, I started to build up a base of people who would buy them from me. But I had to educate people first, almost like how Centennial is doing in South Jersey, right? So he's educating people on how to get into real estate, and he's wholesaling deals to them, right? I'm doing the same thing where I started buying a lot of notes and educating people how to buy notes, and then they become my downline of buyers. So Carl Fisher came to speak at one of my events, and his topic was about IRAs, and that's when I really first learned about IRAs, like this back in 2011, 2012 or whatever. And he had when I was thinking about creating a fund, because my first fund was in 2013, he had told me, hey, I got to connect you with Steve. So we went to it's a private money lender, that's actually the name of it, convention. And he plugged me with Steve. We had dinner, we hit it off, and he became our mentor on raising capital. So he would tell me things on what I need to do, pay on time, communicate, make sure you do the right thing, make sure you protect your investors, you make sure it's secured, all these good things that you need to know. And he mentored me, but he has his own separate fund. He has his own separate fund that he does, and sometimes he will do like strategic partnerships, fund to fund deals. So if I have a deal, and for example, my first $1 million note purchase, I was buying some notes. Hey, I got these notes in the contract for $1 million. And basically we kind of did like a fund to fund thing where he helped me take down an acquisition. So yeah.
It's an amazing and unique fund structure that you have. And it's something that me and Eric actually hope to emulate going into the future. A lot of syndicators, a lot of people raising capital for real estate deals go down the traditional Grant Cardone model where, the typical whole, the syndication groups, right? They do pref, they do equity, they charge a bunch of fees along the way. And if the asset performs, everyone wins, right? But your model, from what I find, is you have to do less deals. You just have to be incredibly selective about it. And your investors get a preferred return only. Can you kind of just walk us through your structure?
Yeah, so when I first started to learn about how funds work, there's several different ways you can do. So it's a fund and then syndication. Syndication, if you're doing a one-off deal, you can do it from a single family point of view, or you can do it from a multifamily. I'll start with the multifamily. Usually there is the capital stack, right? So there's a lender in first position, and then you have the equity portion.
Right.
In that equity portion, you can go where the investors are a second position, where you can raise equity in a syndication, and you can give investors a 70-30 split, 80-20, 90-10, whatever it is, right? And that's all based off your experience, right? Less experience, the more the pie you're going to give up.
Right.
And then, usually with how that structure is, hey, I'm going to give you 70% equity. I'm going to take 30%. I'm the general partner. You're the limited partner. And there's going to be a waterfall structure where you're going to get a pref of 6-7%, where, that's going to be a monthly payment. And anything above that, goes to you till you get your full 70%, and then I get my 30% in the end. And then you model it out. It could be a high teen or whatever it is, IRR. So that's one model. The other model is you can actually have first lender. You can have mezzanine funding in the beginning, and then the investor equity portion will be third. which is really risky for some investors. So they should know what position they're in if you're raising equity. If they're third, second, or more than likely, the institutional lender will be first, unless it's a really small deal. So that is the syndication model. You can do the same thing with the single family. You can do a single family in Short Hills that's, you're buying it for $800,000, you put another $500,000 into it, and you're selling it for $3 million. You can set the structure to deal the same way. Then there's the fund model, and that's the model that I like, and the fund model can have an equity portion also, but we run a model where the people are just debt investors. So they come into the fund. We have different classes in the fund, and our current model is we have a class B, C, D, and E. So B is a long-term, 5 years. C is more like a liquidity class. We use that for short-term. It's a 90-day call option, meaning any time in the fund they can call it, they get their full principal back in 90 days. Then we have a B class, which is a 2-year term, and a E class, which is a 1-year term. So those minimums, there's different minimums, like B and C has a $50,000 minimum, D has a $500,000 minimum, and E has a $150,000 minimum. And they all pay the higher, the class D is 12%, class E is 10%, C is 9%, and B is 11%. So basically, investors has the opportunity to put money in the fund for how long they want to.
Yep.
Based off their portfolio, if they need something that's short term because where we are in the marketplace, or if they need something that's long term because they have their IRA, they're not going to pull money out until later on, so they can let it ride. We have a compounding feature, so it just depends on the investor, right? A year ago or a year and a half ago, it was more of an equity play where you saw more investors that were interested in syndications because they could make a higher yield, right? If they went longer term and got an equity piece. But I just decided, and we felt miserably at setting up a syndication, full transparency. And I'll tell you that in really short, but I discovered that the model we have is best, right? Because I have a mixture of assets in this vehicle that will produce cash flow that's a buffer hedge against market uncertainty, right? So now fix and flips is slow. We still have cash flow for multifamilies, right? It's hard to find deals in fix and flips. So the multifamilies bring that cash flow to generate profit, to continue to pay investors the pref that we agreed to pay them, right? So if you have a one-off type of deal, if you was just in fix and flips and you had a fund doing that, you probably won't be able to meet pref, right? Because you're going to have yield drag because the timeline of the project, investors need to get paid. It's, you want to have different assets in a fund where it could be a buffer, a hedge against market uncertainty. So I believe that played a lot in our success. The quick story on the syndication, we had 120 units, $10 million deal, put under contract, and we were getting close to close. We set up the syndication. It was Q2. It's market change in the Q2, Q3 last year. Interest rates started to, the 10-year was jumping up and down, unpredictable. Investors were getting worried. The news, things are going bad, things about the crash, and investors were fearful. So we had to do what I call in this industry is eating dog food. Like, we had to fund it ourselves. That's what you call eating dog food, when you got to fund it yourself. So we did that, and we tried to backfill the syndication, and it was going really slow. And I made the decision just to wrap up the syndication because it was really hard to raise. Because coming from Q4 to Q1 of this year, investors were sitting on the sideline. Right? It was just really tough. So, but that was a blessing in disguise because it made me know that the model that I have, I need to stick to it. I tried the syndication because investors say, hey, I want the tax break and, I want to get an equity portion. I was like, I never did equity. I think this worked for you. If I can get you a 12%, that's really good. If I can get you 9%, it's really good, right? And our fund is, I can't tell an investor I can guarantee you this rate, but what I could say is that it's cumulative, meaning that if I don't make the pref this quarter and I run into profit next quarter, it's cumulative. You'll get it, right? So, that's how it's set up. And that's a successful model, I believe, for us. I don't know if that works for other people.
I always like to say that I learn from other people's mistakes, but really I just like to make them my own. But I'm going to, for the people that do learn that way, what mistakes have you made in setting up a fund that, had you avoided, maybe would have catapulted you or saved you a bunch of...
In the setup portion, I think not having a clear business plan before I started. So usually what I like to do, especially for like a joint venture. So you could do like a sidecar model where, like, say, for example, you say, hey, Fuquan, I got this really great deal. And let's partner on it, right? We have this 30 unit is X amount of money. Let's partner on it. And I say, okay, let's do a term sheet. Let's outline our responsibilities, right? Who's going to do what? What's the percentage? We'll have a term sheet we'll agree on that first, and then we'll take that to an operating agreement. I think the mistake I made was trying to build the operating agreement at a $550 an hour, or at that time, $400 an hour rate with an SEC attorney, and spend like $25,000 just to get through all the paperwork, back and forth emails. So not having a business plan together up front and trying to figure it out as you go along. I think that's a mistake that I made. My first fund cost me $25,000 to set up. The funds after that cost me less than $10,000.
Wow.
Right? Because I just said, okay, I already did one. Let me take this and I knew all the steps and questions the attorney had asked me up front, so let me fill in the blanks and let me just send it to him and go, here it is. So there's less back and forth. So I think that was a mistake that I made, not really having a concrete business plan in place when I first set up my first fund. What else? I made tons of mistakes in setting up. Let's see. Not understanding that I didn't have to actually set up 4 funds, right? So I told you, when we first started, I cycled through 4 funds. I could have still been on 4-1, but just added additional classes and had a long, extensive track record in one fund, right? I could have been, from the fund I set up in 2013, I could have said, okay, instead of starting a new fund, let me just add another class, and the description of what we're doing here is this, right? So, and now you have a long track record, accounting, everything. So when people say, hey, what are your historical returns? Boom, here you go right here.
Right.
Because when you start a new fund, essentially, you're starting all over again.
From
that
scratch.
fund has no track record, right? You can say, I did this in that fund. I know, what have this fund done?
Right.
What have you done with this one? I'm giving you my money for this one. So those are some of the things that I've learned, and I still learn. It's a whole new business. I keep telling you, it's raising capital is a business within itself, right?
Absolutely.
Yeah.
So you have is it an open-ended fund, closed-end?
No, it has a cap on it. It's a $50 million fund. We launched this fund in January of last year. I was just looking at the numbers yesterday with my investment relation team. We raised $30,750,000 so far.
Nice.
Of the 50. So once we reach the 50, that's it. We have to open up another class, another fund. Because when you add another class to the fund, you can start all over again with another limit, and you disclose to all investors. And basically, is pari passu is not one class is in front of the other. It's the same. So,
We tried to raise money for a pref only deal, and it was hard.
It is. The reason I would say it is because when you have investors that has been investing with you for a very long time, 10 years, they know your track record, right? And if you tell them, hey, I'm structuring it this way because I believe it's safety for you, right? I believe if I'm going to give you a yield, we're in an inflationary market. I'm going to give you something that I feel comfortable with as a sponsor that I know I can pay you. So do you want me to pay? Do you want me to promise you we're going to make 18% and you only make 12% and you'd be mad at me? Or do you want me to say, hey, listen, this deal is really good. I think 9% will be great for you, right? We have these short-term classes where if you find something else that's paying better, hey, you can go with that,
out,
right?
yeah.
You pull out and go there.
Smart.
So, or do you want me to promise you this, and then if I hit 12, you're upset with me? And that's generally
5 years later or whatever. Yeah.
that's generally what happens. I mean, I'm in some syndications. I invest money passively also, and these guys are like, hey, 22% IRR. And it's like, I'm in year 3 and like this thing is doing a 12%. I'm grateful, right? Because 12% is good, but it's not, what he got me all excited about in the beginning, right? So that happens all the time. Overpromise and underdeliver,
Yeah. So what I think you when we were sitting down at the airport, you gave me some unbelievable advice for raising money and how to make sure your investors stay happy. Can you kind of share some of that? What you do to make sure you
For
offer
sure.
great customer service?
So here's what most people I see do, right? They market, they do webinars, they get the investor in, the investor gives them the money, and then, there's no communication after that. I mean, it'd be like quarterly updates, an email, a quick 15-minute video, but there's really no relationship that's building, right? So you have to make the relationship more than just transactional. It has to be, and I think that's the right word, transformative. I think that's the right word. I don't know. So instead of just transactional. And what I do actually is I communicate with investors. Like I was just in Atlanta because I went to do some due diligence on another property in Macon that we're buying. And as I was being driven to, because I had to go to Columbus, as I'm being driven to Columbus, I'm in the car texting all my investors, hey, how's it going? Just checking in and making sure everything goes right. Are you enjoying your summer? Like, I don't want any money. I don't want anything. Just checking in, texting, taking that time to personally text, a couple hundred investors. I'm like, okay, this is going to be like a 2-hour ride. How can I use the best of my time? Let me tap in and communicate. Oh, thank you for reaching out. People schedule call. Hey, I've been meaning to call you. Right, just from that 2-hour ride, I raised probably $300,000 just for texting and following up with people. Right, because I've been meaning to call you. Here's the link. Set up a call. Boom, they set up a call. Right, and I wasn't intentionally doing it for that. Just touching in with them or referral. Right, hey, I've been paying you on time for 2 years. If you think this investment is great, can you refer 3 people? Now they might not refer 3. They might refer 1. Right, and you raise capital from that also, from referral, right? A lot of people don't tap into that referral network. But again, that comes from having a track record, paying on time, doing what you say you want to do, having that communication, even when things go wrong, right? Because things don't go right all the time. Let's not kid ourselves. Everybody don't run a perfect business, right? So you have to communicate, hey, we have an occupancy issue at this unit here. These other units are doing great, but we have problems here. Hey, we had to fire a property manager. They wasn't executing on the plan. Hey, we had to do this, and you're being transparent with them, the good, the bad, and the ugly. They appreciate that, instead of saying everything is great, we're doing great, and behind the scenes in the office, you're putting out fires constantly. So you have to be transparent and tell them that. So those are some of the things that I do really to get the investor to really trust you a little bit more, right? Because at the end of the day, that's really what they want to know, that they can trust you to be honest with them and tell them when you are having problems and what the solution is, right? So. We've increased our communication. Instead of doing quarterly, we do monthly, right? Live webinar, ask your questions, more transparency to the financials. Here's the financial health of the company, right? So, doing those things has helped us tremendously with our investors. Touches, right? One of the things I think I told you was, most people have like a generic package that they send out to an investor when they become an investor in a fund. A handbag with your company name on it or something with your company name. You might want to send them a cutting board with their last name on it. So when they at the barbecue, they got the cutting board there with their last name. Oh, who sent you that? Oh, my sponsors. Or things with their name on it, like grilling utensils or just unique gifts, right? Maybe if you're speaking to them on a Zoom call, you're noticing some things in the background, some memorabilia of their favorite football team, and you send them something related to that. Or you see on Facebook they hike, and maybe you send them a hiking belt, something personal. Right. You kind of create that personal relationship with them so they can see that they're just more than a transaction. Right?
Absolutely. You are paying a current pref month over month, 9, 10, 11, 12%. Mm-hmm. I think it's relatively easy to pay off that type of, it's a high pref you're paying current, right? It's not like they're waiting for their money when you sell and they get it, right? This is a current pref. I think it's a little easier to do that on the debt side of the business. Hard money lending, you're charging your borrowers 10, 12%. You could consistently have that residual income coming in to pay your investors, right? Correct. But when it comes to buying, when it's an equity fund, right? When you're buying actual real estate, where you have to do renovations and there's value add, and maybe the rental income isn't paying a 10 to 12%, right? I think it's a lot more difficult. I'm just curious, like how the heck, even without fix and flips, paying that current pref, how are you meeting such high prefs? What kind of deals are you buying?
Enough performing assets in your portfolio to be able to do that, number one, right? So that's a great question, because you can only pay pref from profits. Right. I want to say it again. You can only pay pref from profits. And that's how people get in trouble, by using capital they raise to pay pref, and then you got the whole, what do you call that? Ponzi thing that's happening. So you want to make sure when you're looking at a deal that there's enough cash flow, right? And your model, like today, our model is not buying anything that is less than 90% occupied unless we get seller financing, and I'll sit that on the table and come back to that. So deals we're looking at, like the 120 unit that we took down in October, right? The biggest deal we purchased was $10 million. That's the biggest multifamily deal we purchased, right? Because we usually purchase smaller, 40 units, 60 units, 120 unit. And we said, okay, this, I think the CapEx was small, less than $500,000 CapEx, but it had a tenant base that was already cash flowing, right? That had an $800,000 NOI, right? So you have to be able to put assets in a portfolio that's going to give a great return. I think it was like a 18 IRR, right? So when we bought it, and that was, we were setting up for a syndication to do that. And that was a pref equity model, but we just moved that into the fund because the fund financed the whole thing. So we moved that into the fund. So that's spitting out that IRR. You know, we have investors all on the different classes. We can afford to pay that because we're just brought in a massive amount of cash flow into the fund. Performing notes. We have notes in the fund that's paying. That's bringing cash flow. The rentals are bringing cash flow. We have a huge injection from a fix and flip, a cash transaction that happens. So having that big liquidity event from a fix and flip, having cash flow from rentals, having cash flow for performing notes help us generate, you know, we just don't have one part where we can generate income.
Right.
So having those different entry points of cash flow definitely help us be able to pay that pref from the profits, right? So, and today we're not looking at any deals if it's not 90% occupied because we can get permanent financing if we're 90 for 90, right? We can get a stable interest rate permanent, and we can have cash flow. We won't buy a deal that's not cash flowing. That's insanity in this market. Like, why are you going to buy something where you're going to have short-term financing and there's no cash flow and you're telling investors, okay, I'm going to go in and execute my plan? What people don't realize in this business, asset management is the hardest part, right? The easy part is just putting together a performer and a marketing piece and going, hey, we're raising capital. We took down a deal. Facebook post like, yeah, we just, it's after that is what the real business at, right?
Amen.
The asset management, the execution of your business plan is the most essential and critical part. Most people are not successful at that. People are successful at finding deals, putting together a performer, marketing the hell out of it, raising the capital, but executing after that, people are terrible with that. That's why a lot of sponsors are in trouble today trying to sell these deals, right? So that's the most important part that people need to pay attention to because that consistently help you learn how to get in there, make that management of that asset better, figuring out other ways that you can generate revenue, right, through RUBS, right, passing expenses along with the residents, creating extra pieces of income. I was at one of my properties and I'm like, oh, these residents are just sitting the garbage outside their door, right? We need to actually start charging an extra $15 a month for service to take your garbage to the dumpster. You can sit it right there. We'll have our maintenance guy do his rounds. He'll take your garbage to the dumpster, $15 a month extra on 120 units.
Wow.
Right? You know how much value
that's a
that
huge
just brought,
amount.
right?
Huge.
Different things like that you can look at from an asset management perspective, figure out how you can add more value to the building. But on the other side, where I said I was going to come back to it, if the deal is less than 90%, we will buy it if and only if the seller is willing to do seller financing with a permanent rate for a minimum of 3 years. If we can get 5, we get 5. A minimum of 3 years, 6%, while we do our CapEx and our renovation, right? Because it's a steady rate. We're getting a huge discount. We're going to go and put up the money. We're going to do seller financing, give them, some money for down payment, and then we're going to implement our strategy and pretty much go from there. And that's the way you can do something that's not 90% occupied if you get seller financing. So using what we learned in the note business, we can implement that strategy there.
Really smart. Yeah, I Josh has given me the wrap up, but I got a couple more questions. I'm sorry, Josh. I'm sorry. You transitioned locally, right? You're still doing local, and being local is a lot easier to asset manage, right? You got your crews, you have your property managers, maybe you're vertically integrated. But going over to the southeast is a whole nother ball game, especially taking down 30, 40, 120 units. Can you kind of elaborate on the asset management, the building the right team, your expansion strategy to make sure that your new investments went well?
Absolutely. So I would say nowadays, like when I was in Philly last time, it was tough because we had no iPhones where you can do FaceTime and you can do Zoom and you can do stuff. So I had to literally drive back and forth to manage the asset, right? So now our model is we have an asset management team that actually manage the property managers, and we're on the phone with them once a week watching KPIs. They fly out to, do the boots on the ground stuff to inspect what we expect. So if you have certain processes or procedures in place, you can be successful, in any state, right? If you have boots on the ground there. So really the whole thing was to plant our flag where we wanted to go. It's like we have the Southeast we can invest in. That's what our PPM say. But we're not in North Carolina. We're not in Tennessee. We're not in Florida. We have the ability to do that because our PPM allows us to do that. But we said we're going to go deep in Georgia and Alabama, and that's it. And we're going to stay there for years until we build those relationships. So we planted that flag 3.5 years ago. And yes, at first it was tough building those relationships with brokers, with contractors and stuff like that. But over time, you get to leverage those relationships into other relationships, right? So that's kind of how we built our team out down there. We have like a CapEx team down there now that, help us. Our contractors sometimes will go to do spot checks on our properties and, get on Zoom with us and let us see the visual. Is the property dirty? Is there grass overgrown? So, it's just really establishing good relationships. That's pretty much it.
Awesome, man. Thank you so much. I wish we could go for another hour.
Yeah, I have questions. I saw Josh 10 minutes ago.
I know you have so much to give, and this is just like the tip of the iceberg. We're gonna if you don't mind, we're gonna have to have you come back.
For sure. I was about to say like how Drink Champs do. They have the same person like 3-4 times.
Yeah.
Well, Fuquan, if the people want to find you, invest with you, send you deals, what's the best way to reach you?
Yeah, I'm on all over social media. You can find me on Instagram, Facebook, Threads, wherever on social media at Fuquan Bilal.
You said Threads.
Yeah, for sure.
Oh, wow.
Yeah, at Fuquan Bilal.
We go.
If you want to find out more information about how to invest with us, you have to be a accredited investor. NNG Capital Fund.com. You can go there, learn more about what we do. And if you hit me on social media, I like to help people who may be a neophyte, new to the business. You have questions, you can hit me up on Instagram, and I'll be happy to help you.
Quan, I love you, man. Thank you so much for taking the time.
Absolutely. It's
Amazing,
been a plum-pleasing pleasure.
We appreciate it.